Hey everybody, it's Pete. Good morning. Welcome to a new episode of Stocks for Breakfast. And today we're going to talk about timing. One of the most challenging parts of trading is getting in at the right moment. We spend a lot of time about order flow. We spend a lot of time about reading the tape. I think the challenge for a lot of traders is they don't understand you need to use both of them and not just one of them. They find stuff on a scanner or they look at stuff that's on a moving average and it happens to be above the moving average, or something was up 10, 15, 20% yesterday, which is a big move for one day, which is actually a gigantic move. We are getting softened up to believe that these 20% moves are normal, but they aren't. So here's the point that I want to get across. If you have found swing trading especially challenging, swing trading has a lot wider moves. It has more overnight risk. And that really implies that it's even more important to have good entries, to have the right entries. Day trading, you're trading on tighter windows. So if you're managing your trades properly, you're going to get in and know exactly where your risk is in a much tighter fashion, which typically day traders can trade a little bit more share size too because of that tighter window. But I think we're kind of really more talking about swing traders here, and if you're not sure, you're not familiar with the language of what swing trading means, generally speaking, the definition is you're looking to hold anything overnight, typically within 2 to 10 days. It's you're looking for that next push. You're looking for that next push. And you're looking for a reasonable return on what you made. You don't necessarily look to hold something for months where you get in today and you're going to get out 3 months from now. Some people do that, but that's more position trading. It's not really swing trading. Swing trading, I think in its original definition, was momentum. So that actually kind of brings us to the next stage of the definition that we want to get across. You have order flow, which is identifying when the smart money is involved, when the smart money is active. So you have two criteria within order flow. You have institutional volume, or maybe that's not the correct word, but you have significant volume. And in my world, that means for a swing trade, it could be anywhere from 1 million shares on average or more. Generally speaking, I like to have at least 2 million shares. And I often get asked why. It's because I want stocks that have the potential to be in play consistently, where you look at the daily chart and you'll see plenty of large green, large red candlesticks. And that means that there is consistent, reliable activity in that stock. The other part is average true range. Average true range is what the stock does from the low to the high on average. Typically, software is default to the last 14 days. That's just the criteria before you even find ideas. So out of all the stocks on Wall Street, I whittle it down to just that criteria. And right now, if I ran that scan, it would probably bring up around 225 stocks. But then you have to find stocks that actually have momentum. And momentum in my world, the way that I teach it going all the way back to when I first started trading NASDAQ stocks in 2000, is we would call a stock well bid. And well bid essentially means that a stock is being supported by institutions. It's being supported by the smart money, where it's pushing to new highs, it's holding higher lows from day to day, week to week, month to month, so that there is movement. We're trading the movement. Now, the challenge where a lot of traders come in, where they find trading to be stressful, is they don't have enough education, they don't have enough training, they don't have enough experience, whichever one of those you want to put into the equation, to recognize that you need activity to make money. We all know that, right? However, they just go right to the momentum part without regard to the odds of making money. So I'm just going to give you a very quick example where, let's say a stock started here and it went up and it went up and it went up. And now you didn't trade the last 2 days, but you find the stock on a scan. You're like, my gosh, this stock has now gone up 3 days in a row. I can't miss it. You have fear of missing out and you get involved in the trade without realizing that the profit potential on what that stock normally does, 40 to 50 to 60% of it's already gone. Think about that. Each trade typically has what it normally does, typically has a reasonable expectation for how much it's going to move in your favor. And if you haven't been in that stock, or if you don't have what we call the optimal entry, you end up chasing the stock, what we call in the boot camp, we call you're chasing price, and you don't allow yourself the opportunity to enter at a good price with the expectation that it continues to move. Your reward will justify the risk. That's the problem. That's the problem that a lot of traders, especially the last 2 months, have been having, where September was bearish pretty much the entire month. October was bullish and then bearish again. And the expectation for follow through to be a buyer, which most traders are, was chaotic at best. That meant that you really needed to dig in and find the right stocks at the right time. And I know that sounds like a cliche, but that's trading at its highest level. When you could make money, when you could be consistent, when you can expect to make money when market conditions are tough, when the market's kind of drifting sideways and it's not just a nice clean move higher and push higher, clean higher, push higher, right? We've been getting now recently, we've been getting these bullish gaps and it's been sucking the life out of the intraday price action if you happen to be a day trader. So what do you do? What exactly is the answer to this? How do you stop yourself from entering too late? How do you stop yourself from putting on positions that have a much lower probability of making money when they are clearly moving as you would expect? Well, that means that you need to wait for a pause. And generally speaking, there's two types of pauses. There's a momentum move to the upside or a move in order flow to the upside that is also accompanied by momentum. So you have order flow, which is the longer term push in your stock. We can look to the left and say, smart money's been buying this stock for at least a few weeks. I want to find a spot now to get involved. After order flow, then you have momentum, which is how many consecutive days has the stock rallied. The first day, second day, third day, fourth day, fifth day, the closer you start to get up to day 4, 5, 6, 7, you go from this much profit potential on day 0, let's call it, to day 2, to day 3, to day 4, to day 5. So if you find yourself running a scanner and the stock, you're like, oh my gosh, I have to get in, I can't miss it. Because of how far it's gone, you're literally getting involved where the risk is more than the reward because it's too late. So I want you to have in your mind, without getting into too much detail about reading the charts, have specific criteria. And here's the key. All you need is one word: pause. Has the stock paused? It could be what is known as a bull flag, where it pushes up and goes sideways for a few days. It could be a rally up and goes down for 2 or 3 days. But the key here is this: you're buying the order flow. You're not buying what it's doing today. A lot of traders are confused about that with like, I don't understand if the stock is going down for the last 2 days, why am I looking for a spot to buy? We get that question a lot in the boot camp. And you have the sequence backwards. You're not looking to buy you're not buying the pullback, you're buying the order flow. The pullback is giving you a chance to manage risk with reward potential, which in this case would be new highs, that justifies that risk. But if you buy after a rally, after a rally, after a rally, after a rally, you're diminishing the reward potential. And that's probably why, if you've been frustrated now for September and October, you haven't been timing your entries right. You've been getting into order flow too late. You've been chasing price. Just have that one word in your mind, which is pause. Pause gives you a chance to manage the downside while the expectation for follow through increases. Even if it's just 1 day. 1 day allows you to kind of reset that clock again. And we've seen that quite a bit. I guess the best example of that recently is NIO, when NIO would push for 2 days and then pause, push for 2 days and pause. At least the 1 day pause gave you a spot to manage risk, and you felt comfortable that if the stock turned around on you, you knew exactly where you were going out. And ironically, during the biggest momentum move, where we kept saying it's the terminology we use in the boot camp is it's a day trade right now, it's not a swing trade. So all of the calls that we make in the way we look at order flow in the boot camp, in the way that we teach in the order flow masterclass, all of the ideas are swing trades. So if you're watching these videos and you're thinking, I'm not a day trader, it doesn't matter. All of the trades that we call out are longer term trades. It's a question of how far recently have they gone, where we'll make the call in our morning game plan, which, by the way, you can watch a video. We had a morning game plan replay up here. You can take a look at that. We'll call out that this is absolutely bullish order flow, absolutely strong momentum, but it's gone too far recently. So we're only going to day trade it and not take the overnight exposure. So I guess the point that I'm getting at is I've gotten a lot of emails, I've gotten a lot of feedback that I see the side, it's really obvious, but I'm still losing money. And that's because you're not timing your pause. So as you're watching your swing trades, especially, make sure order flow is obvious. make sure that the tape reading skills that you need tell you that it's not too late, and then find that pause to manage risk. If you'd like to do this all day with me every day in the boot camp, click down and learn more about it. I think you'll be very surprised at how complete the structure is that what we do. If you just want to stay here and watch these videos, that's fine too. Do me a favor, please subscribe to the channel and leave me a comment below if you have any questions. But just keep in mind, order flow, tape reading, and a pause. That's the minimum criteria to start to look for new ideas. Have a great day.